Good evening, everybody. It is Sunday, January 26th, and we are going to start our report on the COT data that came out on Friday, the 24th. We have a new administration, new fiscal policies, and new all-time highs. So what do we look for next? Do you know where the risks are hiding around the corners? We're going to look at those for the upcoming business cycle in this week's video. First, just a quick reminder that derivatives trading is inherently risky and past performance is not indicative of future returns. So commercials over these last couple weeks have covered their short position, and in the dip down to that 5,800 area 2 weeks ago, and then on the move after CPI from 5,900 to 6,000, we're getting that data, and we see that commercials covered even more of their short position from that 6,100 area. So now they're just sitting at about 20% of their position from historical edges, and that tells us that there's room for risk on the books, and that has allowed the market to have breathing room to get to new all-time highs. And at the same time that we had commercials getting very short into the end of the year, into the FOMC and the repricing of volatility, we saw fund managers and systematic strategies fully invested. And we monitor these strategies because when they have billions invested or billions on the sidelines, we are looking for when there's no buyers left or when there's no more supply left and too much capital on the sideline to be deployed. And so what's happening from a flow standpoint, we have commercials very short. They now cover that position to make their money and to clear some room off their books. Fund managers and systematics were fully invested. They got shaken out on the move from 6,100 down to 5,800. And now we've made a move back up to new all-time highs, and they bought back 20% of their positions to put them at about 85% invested. But now their cost basis is higher. And we see this rinse and repeat washing machine play out time and again. And that's what we want to watch for, because if you follow the commercial money, you can do much better than doing what fund managers are doing or systematic strategies, because they're behaving just as retail traders do, of panicking on the way down and chasing performance on the way up. If you follow where the commercials are, where the part of the business that is controlling this is coming from, you stand a much better chance to then interact when these other sides get trapped in a corner. And so if we look at the last week, just in terms of our levels, and then we'll go through a little bit of what happened during each point, we held our mid rotational zone, made a move up to the upper rotational zone on Tuesday. Monday, we're not going to count very much since it was a holiday for trading. And then we made our breakout over our upper rotational zone, and that told us to look for upside for the week. We got to our upper pivot on Wednesday, and then a little pullback before pushing up and over into Thursday and then Friday morning. So what happened for the week? Again, Monday we had a holiday. Tuesday we continued our markup from last week. Now, again, we monitor other strategies. Wednesday, coming into the day, we knew that there was a $45 billion bid. No matter how much the market moves, we're going to see at least 25 to $30 billion coming in. So if we know that, there's pretty good chances that other market making firms will know that as well, and will be controlling this side of the market to know they can move the market up to have a willing participant that they can sell into. And if you had your own business and on a given day, you knew there were going to be 45 billion people lined out the door, no matter what price you sold your product at, you would mark the price up. That's exactly what's happening here. Raising prices to sell at a higher price when you know that they have to buy. So we got our markup in Globex and at the early part of the day, and then a nice distribution into this move all day during RTH. Thursday, we had a little bit of data on jobless claims, but the bigger factor was going to be Trump speaking. And so we check our insurance indicator that we've told you about to see if people are buying policies or not. So as we started the day, we were very underinsured. This is where we have expectations for insurance. In this yellow box here, green is kind of minimum. We're way below that. So people are underinsured. They wait till the last minute and everybody's worried, is something going to get said that throws us off? So they want to go and protect the money that they've been putting into the market during this move up, chasing price. Now they've got to protect that so they don't lose their jobs. And we see the insurance buy. So in the first part of the morning, this is what's keeping us sideways and a little bit of downside at the open. We're getting that insurance buying coming in. Now, once that's done, we've gone through this pattern again of how these policies get devalued. And we can then see the push that causes that. And that began as we front ran the speech. So we open the market and we have a down move in Globex. We go down a little bit at the open and just sideways until all that insurance buying is done. Once that's done and people have bought the policies for the insurance side of the market, we move the market higher so that those risk aspects have lost their value. And this is how the insurance sales scares people again and again and takes their money. You move the market down, you get people scared, you increase the price of the risk. The storm is getting closer, you can increase the price of the policy. Now, once the storm is either coming or it's past and it isn't as bad as people thought, people try to sell back those insurance policies, but we're moving the market up, so they're worth much less. And so this is how the insurance side of the market is putting money in their pockets. And then on Thursday and Friday, we had some oscillating indicators that we use to see what the market is likely to do, and we were expecting more of a balancing day after getting the headline print of new all-time highs on Thursday on the cash index. And when we failed our rotational high on Friday, and we laid this out, if we couldn't get over 60.56, we were looking for a move back through Thursday's range. That's what we got. And we just made that through our Friday's plan, and that's all that's happening in the market. And we can monitor this day to day, intraday, and on a weekly and monthly time basis. So if we look at the NASDAQ, we'll recap these levels as well. So this was our plan last week on the NASDAQ, very similar to the ES. We held our rotational mid, went to our upper rotational zone, and then right up to our mid level on the upper rotational area. When we can't get over that, we look back for downside just in between this 22,070 and 21,800. For the week ahead on the NASDAQ, we're looking for rotational between 21,967 and 21,350 with our pivot at 21,660. If we get over our rotational high, our pivot's at 22,300 and our target's 22,500. Under our rotational low, we look for 21,000 again and 2850. Now, on the SPX, and we'll go into our levels here for this week, but commercials did clear the way for those all-time highs. Now, this week, we have major data with FOMC and mega cap earnings beginning. So those are on Wednesday. And we have Powell's speech then on Wednesday. We also have mega cap earnings on Thursday and PCE on Friday. We also have the Bank of Japan minutes on Tuesday evening, where traders will look for any signals of what's going to happen in the July meeting there. Not as impactful this time when they raised rates as it was last time in July, because that was the first time in 17 years. But this becomes to be a factor we want to pay attention to as well. So this is where our risks are lying. So we'll look for our insurance buying to come in on these days. And then there's insurance policies to lose value ahead of the catalyst or as we're coming into the catalyst. And depending on how we're positioned, we are either going to see a bottom in the market if there's too much insurance bought, or potential for downside if people decide that it's not worth it. That's when the risk actually shows up and materializes. So if you're unfamiliar with that price action pattern of how these insurance policies work, you can go back to some of our older videos. We've gone through that time and again. This is going to be the biggest thing to watch this week as we go into month end. And Friday, we came into more rotational price action. So we're going to look for a clean break under 6,100 or over 6,150 for our next more trending move. Otherwise, we're looking for this 6,100 to 6,150 to be rotational on a day-by-day basis. Now, for the week overall, though, we are looking for the market to hold, if it's rotational, between 6,146 and 6,004. That's our bigger weekly plan. We'll put out daily plans as the week goes on, and our mid-level pivot is at 60.72. That is also where our line in the sand was on Friday. We'll update that tomorrow morning. If you check our X account or our YouTube, we'll put out a video. But that was where our line in the sand is, and that's what we always want to pay attention to, because if we can get underneath that and change the market characteristically, then we can begin to see more downside. But as long as we stay over that, it will be risk compressing from our market makers, and that is going to support more sideways to upside. So if we get over our rotational high here, we're looking for 62.11 to 62.51. And if we get under our line in the sand and our rotational low, we're going to look for 59.37 back down to 5900 to 58.90. So those are our levels for the week on the ES and the NQ. Some other instruments that are beginning to show crowded trades, and we will put these out throughout the week as they trigger, would be the 6E, the 6N, corn, and natural gas. If these videos help you, don't forget to like and subscribe, and have a great week trading out there, everybody.